The most crucial moments in the trading day. This is Bloomberg Markets The Close with Caroline Hyde, Romaine Bostick, and Taylor Briggs.
Of course, for more market analysis, let's welcome Kathryn Rooney Vera, head of global macro and chief investment strategist for Baltic Capital Markets. I'd love your thoughts continuing the theme that we've talked a lot about, what feels like positive numbers from the University of Michigan sentiment survey, some of the retail data that we got this morning, or are you also thinking that underneath the hood things don't look as good as some of those top line numbers are suggesting?
When you have 9% inflation, you have to look at everything in terms of real numbers. Yeah. So what are retail sales actually doing considering inflation? You know, and I think you do have to look under the hood. And I think it's really important to consider the fact that savings are dropping. So people are spending more, yes, but they're spending more because things cost so much more. Consumer spending at the higher income levels is certainly robust, but as always, it's the lower and middle income people that are most suffering. My expectation, Taylor, is that you're going to get inflation biting, financial conditions are tightening, plus a potential and I think likely rollover in the labor market that's really going to take U.S. consumption down. So some people say we're in recession right now. You know, we could be technically in recession right now, but I don't think so when you have unemployment at 3.6%. I think once you get that rollover in unemployment, which I see going up to 4.2% in the very short term, then you're going to get a recession, economic contraction that's more potent and more real and feels even stronger in 2023. And I think the Fed's going to have to cut in 2023.
And Kathryn, to that idea that we could technically be in a recession right now, obviously we won't know that until we have the gift of hindsight. But even if we were, I'm curious, would you shift your portfolio at all if you knew in this moment that actually we are in a recession?
Yeah, we're not in a recession until the National Bureau of Economic Research says we are. The Fed nowcast even says, 1.5% negative in 2Q. So I think it's generally consensus. I wouldn't do anything right now thinking that we're in recession right now. What I am telling our clients, however, is let's look beyond what consensus is saying. Let's look beyond what all, financial television is talking about. Let's think what's going to happen in 2023 when we really are in recession, when consumption has rolled over, when unemployment has broken 4.2%, and the Fed has to decide whether to cut, whether to engage again in quantitative easing, forget about tightening. 2023 is going to bring its own set of problems. And I think that's where we're positioning ourselves now. Yes, we could be in economic contraction at this point technically, but I'm more concerned about the strength of the labor market, the real structural drivers of inflation, because inflation is not, the structural drivers are not supply chain distortions, they're not gas prices, they're demand-driven forces. So what we need to get inflation down to that 2% from 9% or even higher is demand destruction. And unfortunately, that's what will be required to get inflation back to the 2% target, because I completely agree with Larry Summers. The Fed really went long in the tooth on this one.
So what does that mean then, not just for 2023, but the overall depth of the pain that you might see in terms of a recession? There's a lot of diverging views on here. You have the bank heads trying to instill some confidence that this won't be a really deep or disastrous recession. But what do you think, and how do you trade around it?
Yeah. So I think that the more important recession comes next year. And what I'm telling our clients right now is to maintain their positions, which have done very well. For our clients at Baltic, we've been saying since the beginning of the year, stagflation was our base case scenario, and get in defensives. That's healthcare, that's utilities, that's energy, and that's staples. Get in precious metals. I do think there's a risk of additional Federal Reserve policy error next year. And if I'm right and the Fed goes back to its, book of the recent history of quantitative easing, but in a different environment of still high inflation, then that brings its own set of risks. So I like inflation hedges. I like defensive positions. I think we should broaden our perspective from the traditional 60-40 portfolio and incorporate more of the alternative space into that equation. And I do like increasing cash positions for those that don't have a significant position in that asset class.
I'm going to have to bite the bullet and ask the Miss Caroline Hyde question on those inflationary hedges and those alternatives. Dare I ask if that includes Bitcoin?
So Bitcoin, I think, has a more direct relationship with the strength of the dollar. So as the dollar weakens, Bitcoin generally appreciates. So we've seen the complete opposite. That's why I think, guys, we're calling it an inflation hedge. It's more of a movement historically, if you look at the regression or if you look at the correlation on Bloomberg versus the US dollar. So I still think that you should have a portion of your alternatives portfolio in Bitcoin. I do think that if there is a crisis of confidence, and Taylor, we've talked about this before, with regard to fiat money going forward, if the Fed decides to start buying bonds again, let's say, because we're in recession and inflation has come down, they start buying bonds again, that's going to add fuel to the inflationary impetus. So I think that there is a position there. I just like broad diversification, but I am advising clients to take into consideration that the economic contraction that we're seeing in the numbers right now, I don't think is really what we need to worry about. I think we need to look at the labor market and see how deep of a contraction we're going to get next year.
And Kathryn, we only have about 30 seconds left, but if the Fed were to start up QE again, but we're still in that environment of high inflation that you described, how would risk assets fare? Because normally QE typically means stocks rally.
That's a fantastic question, Katie. And I think the biggest risk that I see, and I'm usually not this pessimistic, but the biggest risk that I see is that the market loses credibility, or the Fed loses credibility with the market, not on inflation fighting, on everything. So that's why I think the biggest risk is the Federal Reserve losing credibility in front of the markets with regard to not just inflation, not just its dual mandate, which it completely went off course on. Larry Summers was completely right. Social justice and climate change are not in the purview of the Fed. But I think that if the Fed goes back to QE and the market says, hey, guys, we still have, 4% inflation, then it loses credibility with regard to its ability to juice asset prices. So my suspicion, Katie, is that the markets would distrust the Fed, and I think that's room for additional error and downside for the markets.
Really appreciate it. And of course, happy Friday. Kathryn Rooney Vera, Head of Global Macro and Chief Investment Strategist for Baltic Capital Markets. Coming up.